Chairman Powell faces serious consequences of the decisions today and May 4th. What's his biggest focus to get to the autumn of this year?
Well, it's interesting to me, if you go back to January, he walked into this year surprisingly hawkish, and that caught the market off guard. I'm looking for three things from the Fed today. I want to see if they're opening the door to 50 basis point hikes and how soon they'll do it. I'm also looking at the quantitative tightening. How fast will they roll that forward? I think they should bring that forward to June. And then lastly, I want to see that trade-off between growth and inflation. For sure, growth will slow down in the back end of the year, but if inflation is still high, I think the market expects they may back off a bit. I think the market will be surprised how hawkish he is today and how focused on inflation he is today.
Well, let's go through that point by point, Bob, and let's start with the dot plot, and then we'll go to the news conference. The dot plot for 23 right now, about 165. For 24, just a little north of 2%. What kind of shift are you expecting there?
Well, it's throwing darts today, given where all the data is. But what I'd like to see is I'd like to see the dots for the end of this year at 2%. And I want to see if anyone has the courage to put them at 3% at the end of 2023.
2%
and I think they
at the end
belong
of this year,
there.
Bob. That's what you want to happen. What do you think will happen?
Oh, I think they'll do it. I'm certain they'll do it. I think they'll throw in a 50 at the May meeting, and they'll do 6 25 basis point hikes at the other 6 meetings this year.
So, Bob, where does quantitative tightening fit into this? How much can they really execute a shrinking of the balance sheet?
I think they'll announce it at the May meeting and do it in June. I think all of it gets pulled forward. Look, they've already made one policy error so far by letting inflation get to where it is. We're looking at the Dallas trim mean personal consumption expenditures. It's close to 7%. And that's without all the inflation that's going in the pipeline now that we're going to see over the next 3 to 6 months. So they've got a lot to do to lean into inflation. And I think what you're going to hear from them is that's their focus, even if it means sacrificing growth at the end of the year.
Well, but Bob, that's exactly where I wanted to go, because you're saying that they've already made a huge policy error, but a lot of the inflationary inputs are far out of their control. They are commodity driven. They also are driven by some of the pandemic era distortions. So at this point, is that the only tool they have to materially slow the economy even further than inflation will do naturally?
Nonsense. Not everything has been out of their control. There have been an awful lot of things that have been in their control. Look at the price of new homes. Look at the cost of shelter, the cost of housing. That's gone through the roof. Why? Because if it costs more, but the cost to finance it remains close to zero, guess what? You can pay more. They should have hiked rates and stopped purchasing mortgages 6 to 12 months ago. And that would have slowed down the housing market a bit. I think they've got a tough summer ahead because there's a lot of pent-up demand yet to be satiated. That's going to happen over the summer. I see the toughest month for them to get through as July.
Bob Michele, you know how this works. You dial 1-800-BOB-MICHEL. You got a ton of money to put to work. What do you tell them now? Where'd you put it?
Well, as you know, we walked into this year somewhat conservative, thinking that things had gotten a bit of ahead of themselves in the credit market and raised cash. Now we're putting it back to work. I think over the course of a couple months, we've got a year's worth of repricing. We're looking at high yield, for example, that we came into this year at an all-in yield around 4%. We're now at over 6%. You look at investment grade credit, spreads have gone up from 80 or 90 basis points to 150 basis points. Yields are up 1.3%. So there's a lot of concern about what's going to happen to corporate America and corporate Europe. We think they'll be more resilient than a lot of investors anticipate, and there's a lot of cash on the sidelines. There was a lot coming into this year because of the de-risking. More has built up. I think you're going to see that put to work in the second quarter.
Bob Michele, Friday evening, 7 p.m., you're gaming Liverpool's next victory. I'm reading Kasman and Feroli cover to cover in Weekly Prospects. As you read your colleagues, Kasman and Feroli, what does it tell you, given higher yields, what foreign flows will do? My problem with the doom and gloom of moving out to higher yields, lower fixed income prices, is the foreigners always show up, don't they?
Yeah, they do, and you'll probably see some of that in the coming quarter, because for sure you're not going to see the Bank of Japan raise rates in here. For sure the ECB, I think they'll still hike this year, but they'll talk it down until the back end of the year. So that money will look at the higher yields and come in. That's probably why you don't get to 3% 10-year treasuries over the next couple of months. Can you get there by the end of the year? I think with the inflationary pressures in the pipeline, you will get there.